We've made a strong start to FY27 with another quarter of operational momentum across the New River portfolio. What is encouraging is that the performance is not being driven by one isolated factor. It reflects the strength of our strategy, owning and operating essential everyday destinations, keeping rents affordable, working closely with our occupiers, and compounding value through active asset management over time. In the quarter, we completed over 70 leasing transactions, securing almost £2 million of annualised rent. Those transactions were completed ahead of ERV and ahead of previous rent, marking our 13th consecutive quarter of leasing outperformance versus ERV and our 8th consecutive quarter of outperformance versus previous rent. Occupancy increased to 95.4%, tenant retention remained very high at 96%, and customer spend across our portfolio outperformed the Lloyds Bank benchmark. The strongest areas of spend were in non-food discount and everyday goods, which speaks directly to the role our assets play in the communities they serve. We also completed the acquisition of our joint venture partner's 90% interest in the Moor in Sheffield, taking our ownership to 100%. We've managed the Moor since 2021, so we know the asset well. Acquiring it at a significant discount to its March valuation and at a 10% net initial yield is a good example of disciplined capital allocation, buying an asset where we understand the opportunity and where we see a clear route to further income and capital growth. The transaction also concludes a successful capital partnership with Bravo, which has delivered an IRR to New River of around 21%. That is an important part of our story. Capital partnerships allow us to use our platform, our relationships, and our asset management capability to create value beyond the balance sheet alone. We also strengthened our balance sheet with a new £240 million unsecured facility. This improves our liquidity, extends our debt maturity profile, and supports our longer-term return to a fully unsecured debt structure. Taking together, this is what we mean by compounding value over time. Resilient, everyday retail, affordable rents, consistent leasing performance, disciplined capital allocation, and a platform that can create income and capital growth for shareholders. There is still plenty to do, and we remain focused on execution. Q1 has been a positive start to the year and gives us confidence in our ability to continue delivering attractive recurring income returns and long-term value for shareholders and partners.